Good afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Today, we continue our webinar series surrounding COVID-19 and the global pandemic's effect on the automotive retail market. Before I introduce today's presenter, a few quick reminders. Everyone that is registered for today's program will receive a copy by early next week. If you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar, and Charlie will try to get to them all. Also, I just want to give a quick thank you to everyone that registered for today's program. We're a small operation here at AIADA, and I realize there are a lot of other webinar programs out there. We take pride in our sessions and try to bring you the most relevant and current information. So every time you register and return for our webinars, that just really means a lot to us. So let's get right down to business. Join me in welcoming back Cox Automotive Senior Economist, Charlie Chesbrough. Charlie, take it away.
All right. Well, thank you, Rachel, and thank you to everyone for joining us here today. We're going to give you the update on what we're seeing out there regarding the virus, what it means for the U.S. economy, and then to give you an update on some of the metrics that we track at Cox Automotive and what we're seeing out there in terms of sales and at auction, and talk a little bit about maybe some strategies or things to be aware of as we're trying to deal with this lack of demand out there in the marketplace, because there is going to be opportunities, but they are going to be more scarce than they have been before. So let's talk about the virus. This is a map that's showing where the virus is most heavily impacting markets around the country. And you can see clearly New York remains the epicenter. We're at the point now where we have 1,050,000 cases identified. We're approaching 62,000 deaths. I think we lost another 2,500 people just in the last 24 hours. So this virus is still raging. As I told you before, it was going to be a rough month. April's looking to be sort of the worst of this thing, and it's certainly meeting expectations at this point. It's been bad. But the good news is that we are starting to see some significant changes around the country where the virus is starting to deteriorate. We know that some parts of the country, particularly in the middle parts of the country, they are starting to open up for business again. And the expectation is as we get through the course of May, we're going to see many, many more parts around the country start to reopen, so at least that they will be able to do business. What is unknown is what is the response from consumers going to be? Are they going to be willing to go back out to the restaurants, back out to the various service providers? That's a big question mark. We don't know yet, but I think it's safe to say that it is starting to appear that we are at least getting to a point where we can start talking about the recovery phase, and that's going to be coming soon. But we still have to deal with the economic consequences, and I showed this slide just to kind of remind us all where we were back in February of 2020. I think historians are going to write that we entered into this pandemic with a U.S. economy that was maybe in the strongest position it's ever been. On the left, we can see initial unemployment claims were at 50-year lows. The unemployment rate was, at 50-year lows as well. We were really just in a tremendous situation. And then the virus really started to hit around mid-March. And the next slide I'm going to show you is this initial unemployment claims that's on the left. But this is after we had the last 6 weeks of data. And I put that in there really to show you the perspective of what we're dealing with, the magnitude of job losses that we've had in this U.S. economy. Really cannot be overstated. We just had another initial claims report out today. Another almost 4 million jobs were lost last week. We're now up to 30 million jobs lost since the middle of March. This means the unemployment rate is going to be rising dramatically. It's expected to be somewhere in the 15 to 20% range by when they report it at the end of next week. This is territory the U.S. economy has not been in since the Great Depression, excuse me. So we are in really uncharted territory. But the expectation is that the vast majority of these job losses were temporary, that a lot of them were restaurant workers, service workers, and that Congress passed very aggressive bailout programs over the last couple weeks, and are providing a tremendous amount of funding to these people. And it's hoped that those that have lost their jobs through extra pay that they're going to get through the federal government, as well as their own unemployment compensation through their states, that it can carry them through the end of July. And at that point, it's hoped that there'll be enough economic activity that we can have the reopening of the economy and these folks can get hired quickly. That's the plan. But it is, the longer that we're shut down, the longer this virus lasts, and then we're not able to open businesses, that plan's going to get a little bit more derailed. But we're not quite there yet. It's still hopeful that that's the trajectory that we're going to be on for the summer. Now, as we talk about initial claims, the other thing we got to keep in mind is that the impact of this virus and the impact of unemployment varies substantially across the country. Not everybody's in a horrible situation. We can see certainly Michigan and Georgia and Pennsylvania, and I think after today's news, Florida will be shaded red as well. Some states are being hit very, very hard with unemployment, in addition to having tough outbreaks with the virus, sort of a double whammy. But as I said, there's other parts of the country that are not suffering the same, and it's this discrepancy that we have around the country that not everybody is in the same boat. That means that we are seeing economic activity out there. And for the vehicle market, I'll show you some slides in just a minute, it does appear that maybe the worst is behind us, and we're starting to see some upticks as markets open up, as dealers are allowed to sell in other parts of the country that have been previously shut down. And because there's such varying degrees of impact of this virus across the country, there's also quite a bit of variation in how consumers are perceiving this. And certainly consumer sentiment is critical in this environment. We want to have very optimistic, very high sentiment consumers, because they're the ones who go out and spend money. They're the ones who are going to go out and buy a vehicle because they feel confident about the economy, because they feel confident about their job. But the impact of this virus has been varied across the country. And this is a slide that's showing consumer sentiment as measured by Morning Consult. And they talk to thousands of people each day around the country and ask them what are their views on the virus and the economic outlook. And you can see that in some states we've seen a massive, severe drop in consumer sentiment. But in other markets, it hasn't been near as much. And so it's this variation that means that the reason why parts of the country are going to open while other parts are going to remain closed, but on the whole, the vehicle market sales themselves should start to improve throughout the course of the month of May. Now, this is a slide that's showing the overall consumer sentiment for the country. And really the big story out of this is you can see that sentiment was fairly stable prior to the collapse in early March, but then it's leveled off again. We're sort of at a new plateau, and this suggests that consumers have sort of readjusted their expectations. They've now sort of incorporated this initial shock of this virus, and we're now sort of hovering at a lower level, down 25 to 30% from where we were before, but it's not still falling. And I think that's really the key point. Just like we look at the stock market, it fell dramatically when news of this virus first came out, and ever since then it's been ticking back a bit. And again, it does appear that we've sort of reached the bottom on many of these metrics. And one of the reasons that people are getting a little bit more optimistic is, I said, that consumers have started to level off. They're not becoming overly concerned or pulling back entirely from the marketplace. There is still interest out there. And we've done a lot of surveys at Cox Automotive that are revealing this through the data. On the left here, I'm showing survey results we did from talking to consumers that are out in the marketplace and said that they're going to be buying a vehicle sometime in the next 6 months. And we talked to these folks, and they said, as you can see on the left here, that they're going to be delaying their vehicle purchase. In early March, when the virus was still in its infant stages, only about 7% of consumers were saying that they were going to delay their vehicle purchase. But you can see by the end of March, that really spiked to about 35%, but it's pretty much held at that level since then. We're not seeing any significant move from consumers. How long are they going to delay it for? Well, that's been changing as well. We can see on the right here, when we first asked this question back in mid-March, about 32% of people saying they weren't sure how they were going to delay this virus, and 30% said that they were going to delay only up to about 2 months. It's gone through a number of iterations of that, and you can see that earlier in April, there was a little bit more optimism. Folks were saying that they were only going to delay up to 2 months, but now we've seen a little bit of a shift back, as we can see our latest data points, that there's a little bit more uncertainty, that folks that were going to wait up to 2 months are now saying that they're going to wait a little bit longer. It's not surprising. There's a lot of moving parts out there. I'm sure all of you, just like I am, we're trying to watch this news every day and understand what is going on with the economy. It's not surprising that consumers are going to see their own outlook on this vary greatly. I think the key takeaway from this, though, is that there is still interest out there to buying a vehicle. People are not saying that they're not going to buy at all. It's just that they're going to delay until they know exactly what's going on out there. And we're getting similar results when we do surveys asking about the fixed operation side of the business. We ask folks, are you going to be delaying repairing or servicing your vehicle? And we can see in early March, only about 5% of folks were saying that they were going to wait, but that's actually risen all the way up to 40%, and it's since pulled back a little bit from there. Again, suggesting that consumers are starting to get used to this virus. They understand what it is, what their risk is, the exposure, and they're starting to pull back a little bit on the likelihood to delay on the servicing side. I think this is good news. This is indicating that consumers were a little bit more reluctant to spend money on repairs, which is understandable. When you're facing a recession, you want to conserve money. You want to only spend on things that you have to. But now we can see that consumers are a little bit more willing to open up that pocketbook. And I think the fact that dealerships themselves have adjusted the way they do business. We know that there's much more work being done to try and provide services for customers without actually having to interact with them. Certainly digital retailing has had a very positive impact on being able to sell to consumers without actually having to actually interact with them on a face-to-face basis. And what we can see on the servicing side as well is that consumers would prefer to stay home, but we know that dealers who are able to offer pickup and drop-off services, types of activities where they're not actually interacting with the consumer, that's something that will get interest from consumers, and they will be willing to pull the trigger and actually do some repair work. There's other indications that we see out there as well that are suggesting that maybe the worst of this is behind us. And we know that there's a tremendous amount of shopping that's going on the internet for vehicles. Now, many of our shopping sites, AutoTrader, Kelley Blue Book, are all showing increases in activity and shopping online, which is not surprising, right? Folks are stuck at home, they're looking for something to do, and so there's a lot more activity in terms of shopping for a vehicle. But I do think it also kind of lends to this idea of some pent-up demand because they could be doing all kinds of things on the internet. And what do people want to do when they're in the depths of a pandemic? Well, they want to look for new wheels. So I think there's always, there's something about getting a new car that is always of great interest and aspirational for people. And it's not surprising that that's something that's of great interest as we're in the middle of this crisis. The other thing we're seeing in some of our other product sites, dealer.com has seen new vehicle form submissions outperform. DealerTrack credit applications have been down, but the rate of decline has been improving substantially. We saw some numbers down 80–90% in some markets on applications. Now they've slowly been rising. They're down much better than that, but still down. But again, it does appear that we've sort of in the rearview mirror as to sort of the bottom of this crisis. And a similar story at X time, where 43% of consumers are having their car serviced, but that's better than what it was just a couple weeks ago, which was below 50%. So what does all this mean for vehicle sales? Well, I think we're going to be making hitting some record territory here for the month of April. The results are going to be announced tomorrow on May 1st. Today is the last day for sales for April. And the expectation is that vehicle sales are going to come in around 7.5 million on a seasonally adjusted basis. In terms of volume, it's very possible that this will be the lowest selling month, at least going back 45 years to the mid-1970s. Possibly about 600 to 650,000 vehicles is sort of the range that we're talking about. There's really no great way to spin that other than it's not surprising. We expect the market to be pulling back substantially. We were humming along at a 17 million selling rate for a number of years, but finally the virus is catching up, and it's really going to take volume out of the market here in the month of April. But as I said, April should be the worst month, that we should start to see May get a little bit better. Now, one of the things I've shown on this slide as well, this is showing the monthly light vehicle selling rate in blue. That's for all vehicles. But I split out the selling rates for cars and light trucks. And it's really interesting here because you can see that it's really been light trucks that have really been driving this market over the last few years, as the interest in passenger cars has really fallen by the wayside with consumers and the manufacturers themselves of getting out of those segments. But that does leave the industry in a very precarious situation, that we've had 10 years of a fantastic economy. Everybody wanted all the technologies, the bells and whistles. They wanted the crossovers versus the passenger vehicles. But all of that is much more expensive. And now we've created an industry where we don't have a lot of low-cost products. And the fact that we don't have as many passenger cars out there may mean that we're a little bit more vulnerable to this because we don't have lower price points for those consumers that are going to need it. So what are we seeing in our daily sales? Well, it's actually starting to improve. This is showing from our dealer track data, we have the ability to monitor a couple of hundred dealers and their sales activity on a year-over-year basis, the same day this week versus the same day of the week last year. And you can see here in green, that was the year-over-year change from 2019. And in orange here is what we're seeing in the year-over-year change for 2020. And we can see that in early March, sales started to decline rapidly until we hit essentially April 1st, and that's when we reached the bottom of this market, where we saw daily sales falling up to 80%, but it started to improve since then. And we think there's a number of contributing factors here. One, as I said, consumers have readjusted. They pulled back from the market, but now they feel a little bit more comfortable, so they're coming back into the market. But also, we know dealerships themselves, many were forced to close in early April, and now more dealerships are being allowed to open. And even in some states, dealerships may be closed, but they were allowed to do digital transactions. In my home state of Michigan, the governor allowed that to start happening last week. So that's also contributing to an uptick in volume. But the key takeaway here is that as down as it is, it's starting to get better. And so it does appear, it seems highly unlikely, unless it's just a calamity with this virus here in the fall or in the winter, that we're going to reach these depths again. We're going to start to see things get a little bit better. And when we look at the used market, it's also a very similar story as well. We can see that in early March, this started to fall dramatically, bottomed out at down about 70% on a year-over-year basis, same store, same day sales. But now we're only down about 36%. So it's really starting to show improvement. And again, I think a lot of it can be attributed to the fact that dealerships are opening in this digital transaction. And I think that's one of the things that we're going to see as an industry as we look back on this when all the dust settles, is that digital retailing may be, we've been at Cox proposing that for quite some time now, but I think it's really going to come to the fore that it's going to be a real necessity out there in the marketplace going forward. The other interesting thing we're seeing out there is what's happening in the used market at auction. And we know that there's a whole bunch of inventory that's building up at auction. Many of Manheim auctions have been closed for the physical auctions. We do digital auctions, but the volumes aren't nearly the same. But there's a whole bunch of inventory that's building up, and that we've started to see that the wholesale values are starting to decline. And this is a chart that's showing the month-over-month change in the Manheim Index, which is our measure of the value of used vehicles at auction. And we can see here that it kind of hovers around zero for the most part, not substantial change, but we can see in just the last couple of weeks a substantial drop in the month-over-month change in Manheim prices. This is something that's very disturbing for many of the lenders out there. There's a whole bunch of vehicles that were leased back in 2017 with a residual value that's coming back to auction, and that residual value is not being realized. And a lot of lenders are having to make a decision: do I sell the vehicle anyway, or and lock in a loss, or do we try to find a way to mitigate that? And we know many manufacturers have been extending leases. I just don't want these vehicles back right now for folks that are off lease. But there's going to be a tremendous amount of pressure building on the used market here over the next couple months. Not only do we have the off lease volumes coming with the auctions already backed up because they've been shut down, but we know the rental car agencies are sitting on a whole bunch of inventory. The likelihood of heavy business travel and family travel here by the end of summer seems pretty unlikely. So one would expect that the rental car companies themselves are going to have to start getting rid of some of their inventory. And when we think about the likelihood that there's going to be more defaults, more delinquencies, one would expect that repossessions might start to take an uptick here over the next few weeks, or at least certainly later in the summer once these unemployment checks run out. That's going to add even more supply to the auction. So this is something to keep an eye on. I don't really have an answer for you what dealers should do with their own strategy, but I would say that there's going to be a lot of downward pressure on used vehicle prices here over the near term, and it's going to be critical to make sure that you manage your own inventory. And I would suggest that, you know, cash is going to be king here for the next few weeks. That retail sales are going to remain muted even in May. They may be a little bit better, but they're going to be low. You want to make sure you've got enough cash on hand to weather the storm, and that may mean selling a few vehicles for a loss that you might not have otherwise, just to make sure you've got that money in the till. The other thing that I think that's really interesting that's going on out there is that we know that for those that are buying, what's really moving the needle are these 0% financing offers. We've seen tremendous activity from consumers out there, not only researching them on the internet, a lot of shopping on there on the 0 for 72 and 0 for 84 offers, but we're seeing it in the actual transactions themselves. And certainly the pickup truck segment has been a big beneficiary of this. We've seen a nice little increase in pickup truck sales relative to, or at least their share of the market relatively to what it was before. You know, this is kind of an interesting aspect for the industry. You know, we haven't really done 84-month lending here. You know, pretty much 6 years was kind of the max. 72 months seems like it's long enough, but to go 7 years, you know, that may be the new ground here in the U.S. vehicle market. 84-month financing is very popular in Canada. I think somewhere in the neighborhood of 30% of the market up there is very long-term lending. So that may be, again, one of the things that we see that emerges from this virus, that 84-month lending becomes the new norm, or at least more normal than it has been before. And I don't think it's surprising. You know, this is a way that the monthly payment can be dramatically impacted. And just to kind of give you an idea of that, I have on the right, or excuse me, on the left here, I'm showing you monthly payments and the monthly payment terms at 0% financing for a $20,000 loan, $35,000, and a $50,000 loan. And you can see that the longer the 84-month financing offers, you have the lowest payments. But where there's real savings to be done is if you can extend the loan terms. If you're a lender and you can move people from a 0 to 72 to a 0 to 84, so just extend that loan term 12 months, you can knock substantial money off that monthly payment. And just to give you an idea of what I'm talking about, if you look on the left here, the 72-month green bar and the 84-month green bar, well, that difference there is what I'm showing on the right. That's $99. So if I move someone from a 72-month loan to an 84-month loan, I can knock $99 off that monthly payment. Now, we all know that, you know, financially, someone might not want to be in a vehicle that long. There's all kinds of reasons not to do that. But for those shoppers out there that are serious about the monthly payment and trying to keep it as low as possible, these long loan terms at these low interest rates may be the easiest way or the most impactful way to really impact buyers out there. And I would suggest that, you know, we may see that even because there's so many 84-month and 72-month offers out there, it may become a real challenge to leasing, because even leasing for 24 or 36 months, you may not be able to beat that long-term payment option that's going to be available there. The other thing I think that we have to keep in mind here that could be an obstacle to the comeback that we're dealing with is the fact that we've had years of getting away from lower priced vehicles in the light vehicle market. And as I was mentioning before, that we've gotten away from cars. Well, we've also gotten away from products less than $30,000. What I'm showing you here on this chart is the market share of the industry by different price points. And so in 2012, 51% of the market had products that were less than $30,000. By 2019, only 28% of the market has a price point less than $30,000. And on the flip side, in 2012, only 6% of the market had price points above $50,000. Now it's almost a quarter of the market is above $50,000. These are very high price points and not a lot of product options on the low end that could make the industry vulnerable because of this, you know, economic calamity that we're dealing with. Consumers are going to be looking for value out there. They're going to be looking for ways to save money, and that could be a challenge in the light vehicle market because we've had this inflation within vehicle prices. The other thing I see out there that could potentially be a threat to new vehicle sales is the gently used market, as we call it. These model year sort of 0 to 4-year-old vehicles. These could be generally we used to think in the industry, oh, no new buyer would consider used, the two should never meet. But boy, when you're in the middle of a recession, you're concerned about the outlook, and I can buy this, brand new vehicle over here, for a significant amount of money, or its 3-year-old version of it for half the price with a few miles on it, boy, that used vehicle starts to look very attractive. And I think it's something that the industry could see, that they're going to lose some buyers to the used market because the price points are going to be so good. And this is a trend that's been going on for quite some time. The chart I'm showing you here is looking at, in dark blue, new vehicle sales, and I've overlaid it by what we see for model year 0 to 4-year-old registrations. And so we think of the vehicle market as being somewhere in the neighborhood of 17 million new vehicle market. Really, I think you should think in bigger terms, that if you think of consumers who are buying an expensive vehicle and have to take out a loan and have a monthly payment, and generally that would include all of those model year 0 to 4-year-old vehicles, it's a much bigger market, close to a 28 million market of those folks out there, with almost 12 million of those purchases in 2019 being these gently used vehicles. And what we've seen as a trend is that if you think of the market as this much bigger picture of new and gently used from a consumer's perspective, that used share has been rising rapidly. We're now going to probably this year finish close to 43% of that potential market is going to the used side. And we expect volumes to be down on new and gently used this year. But as I said, there's going to be a lot of product out there that could provide tough competition for new. So again, it's just one of these things to keep in mind. So one of the things I think it's important to think about is that from a consumer's perspective, I'm going to be strapped because of the fall in my net wealth. The fall in the stock market has certainly hit investors hard, 401ks hard. And so we would think that folks are going to shy away from the higher priced products. And so what I've highlighted on here is sort of a grid that's looking at the average transaction prices for different brands. And then I've also overlaid what the average loan interest rate is. And that interest rate is really sort of a proxy measure for the type of customer that normally buys that product. And with higher interest rates reflecting a lower FICO score type customer, and of course, very low interest rates reflecting your best credit customers. And what I see potentially happening in the market is people wanting to shy away from expensive products, but we may also have sort of this additional factor where folks are going to be squeezed by not being able to get credit because lenders are going to be reluctant to sort of lend to these low FICO score customers. There's going to be a flight to quality, just like we see in the global financial markets. When everything hits the fan, folks want to own U.S. treasuries, U.S. large cap stocks, U.S. assets. Well, when we're seeing something similar in the auto lending department, lenders really want those 800 FICO score customers. And it may be that, Mitsubishi, for example, they cater to the lower FICO score customers. Well, their customers may not be able to get credit approved as easily as it was before if we start to see a bit of a credit crunch out there. And if we look at the market in a similar way by vehicle segments, and this is Kelley Blue Book's segmentation, again, it's a similar story that we would expect, high performance cars and high-end luxury cars to be particularly vulnerable because of their high price points. But it may also be that even in the lowest priced products, like the subcompact car or compact car, even though they've got the lowest price in the market, they may actually not get as many sales because their consumers or their natural buyers can't get approved for credit. And I would say even in this example, when we think about who are the folks that, those 30 million folks that lost their jobs over the last 5-6 weeks, well, those are hourly workers. Those are restaurant workers. Those are, retail store workers. And many, many of those folks are going to be these lower FICO score customers. And in fact, J.D. Power had a presentation the other day, and they showed some year-to-date numbers, month-to-date numbers looking at different segments as well. And they were showing compact cars down even more than every other segment. And I think that does lend some idea that these customers in particular have been hit pretty hard by at least this first wave of this downturn. This other slide I've shown to you guys before, but I think it's just worth covering again because there is going to be opportunity out there. We estimate there's going to be about 4.1 million off-lease vehicles coming back to the market in 2020. On average, that runs about 340,000 people each month with their lease expiring, and they need to get new transportation. That's almost guaranteed demand out there. Many folks are being offered extensions on their current leasing terms. As I said, the manufacturers don't necessarily want all these products back right now, but that's really only a temporary solution. They're still going to be coming back. But I do think that we have to keep in mind that these are your choice customers. These are your tier 0, 800 FICO score type customers. It's going to be really competitive for them. A lot of conquest programs, a lot of loyalty programs. It's going to be very aggressive as the manufacturers fight for these customers. But we do know that they're going to be out there, and they will provide just even a baseline level of demand. And just to kind of do a subset of that is looking at the luxury segments as well. Clearly, there's different manufacturers out there in terms of how many leases they've got expiring, but the story's going to be the same. We got about 90,000 folks each month on average that are going to be out there looking for transportation again, and that's going to be real opportunity to try and sell to these folks. So just something to keep in mind as you start thinking that there isn't going to be any demand. There will be demand, and there are going to be consumers out there that just have to buy a vehicle. They're not going to wait for this crisis to pass. But it's going to be competitive out there, and they're going to be shopping hard. But I think at the end of the day, I think there's a lot of indications to suggest that we are starting to see the worst of this behind us. It's not to say that the grass is incredibly green in front of us, but it does seem like it is going to start to get a little bit better. With May starting to show improvement, June should even show more improvement. And then most economic forecasts are expecting that by the time we get to Q3 in July, that's when the economy is really going to start to show growth again. And we'll start to see real significant growth in economic output, which should translate out into significantly more hiring. And that's when we start to really get on the other side of this virus. But we've got a few months till we really get there. So those are my comments. If you have any questions, please go ahead and submit those. I'd be happy to answer any questions.
Charlie, thank you so much for taking the time to speak with us today. I know you're a busy guy these days, and we really appreciate it. We look forward to having you back to update us again on June 4th. To everyone on the line, if you missed it, you will be receiving a copy of this recording by early next week. To continue our COVID-19 webinar series, join us back here for a special session on Thursday, May 7th at 4 p.m. Eastern special time, as Google shares with us their just released report on accelerating automotive trends. So be on the lookout for promotions on how to register. For more information about AIADA, visit aiada.org. Thanks for joining us, everyone, and have a great day.